This broke. Silver has plunged 8% in a single trading session, collapsing from recent highs into a sharp, violent drawdown as liquidity across global markets begins to thin at precisely the wrong moment. And while most headlines are framing this move as routine volatility or year-end positioning, what is unfolding beneath the surface is far more consequential. Prices are not simply falling, they are revealing strain. The sell-off is occurring alongside widening bid-ask spreads, synchronized weakness across precious metals, and a sudden scramble for dollar liquidity that is already rippling through adjacent asset classes. By the end of this analysis, it will be clear that this is not about silver alone, nor is it about sentiment or speculation, but about a system that increasingly struggles to provide the liquidity it promises under stress. This is not a moment to glance at a chart and move on. It is a moment to understand what is being exposed, because the forces driving this move do not resolve quietly, and the question that remains unanswered is whether this is a contained dislocation or the opening phase of something much larger. Under normal conditions, the global precious metals market is assumed to function as a deep, continuously liquid system, capable of absorbing large flows without destabilizing price discovery, supported by futures markets, bullion banks, clearing mechanisms, and the implicit assurance that paper claims can always be settled smoothly. This assumption rests on confidence that counterparties will remain willing and able to intermediate risk, that leverage can be rolled forward, and that cash is always available at a reasonable price when needed. For years, this structure has been treated as robust, even elegant, a model of modern financial engineering that allows price exposure to be distributed efficiently across institutions, funds, and hedgers. Yet that confidence depends on a critical condition that is rarely tested in calm periods, namely the continuous availability of liquidity during moments of stress. When that condition weakens, price does not drift lower in an orderly fashion. It gaps, it cascades, and it disconnects from underlying fundamentals, and that is precisely what today's move is signaling. What makes the current environment particularly fragile is that the system is already operating with reduced buffers. Balance sheets are constrained by regulatory capital requirements, repo markets are increasingly sensitive to collateral quality, and dollar funding has become episodic rather than abundant. Liquidity today is not a permanent feature of the market. It is a temporary state that must be actively maintained, and when multiple participants attempt to secure cash simultaneously, the system reveals its limits. The sharp decline in silver is occurring alongside signs of stress in correlated markets, indicating that this is not an isolated repricing, but part of a broader dash for liquidity. The fact that the move is accelerating rather than stabilizing suggests that market depth is thinner than widely assumed, and that selling pressure is meeting fewer natural buyers willing to absorb risk at current levels. History offers uncomfortable parallels when systems built on confidence begin to falter under liquidity pressure, and one does not need to look far back to find an instructive example. In prior episodes where markets were believed to be liquid and self-correcting, confidence often held until it did not, at which point price movements became abrupt and non-linear. During earlier financial disruptions, assets that were considered stable or well-supported experienced sudden air pockets when intermediaries stepped back, not because fundamentals changed overnight, but because the ability to finance positions evaporated. Authorities often responded by injecting liquidity, expanding balance sheets, or temporarily relaxing constraints, measures that stabilized prices in the short term while leaving deeper structural imbalances unresolved. These interventions were framed as successes, yet they came at the cost of increased leverage, moral hazard, and greater dependence on central support, setting the stage for more severe dislocations later. In those earlier periods, confidence deteriorated gradually before breaking sharply, and the initial price moves were frequently dismissed as technical or idiosyncratic. Only in hindsight did it become clear that they were early warnings, signals that the plumbing of the system was under strain. The relevance of those episodes today lies not in their surface details, but in their mechanics, because the same dependence on continuous liquidity, the same sensitivity to funding conditions, and the same reliance on confidence are present now, albeit on a larger and more interconnected scale. As selling accelerates and liquidity thins, the market begins to behave less like a mechanism for efficient price discovery and more like a stress test. And the question that naturally arises is whether the current decline in silver represents a contained adjustment or the reemergence of a familiar destabilizing pattern. The critical lesson from past liquidity-driven disruptions is that markets rarely fail because participants suddenly lose faith in an asset's intrinsic value. They fail because the infrastructure that allows risk to be transferred and financed becomes constrained. In previous episodes, once funding stress emerged, institutions that normally provided depth withdrew simultaneously, not out of malice or coordination, but because their own survival depended on preserving capital and liquidity. This withdrawal transformed routine selling into disorderly liquidation, magnifying price moves well beyond what fundamentals alone would justify. Precious metals markets, despite their reputation as safe havens, were not immune in those moments, precisely because their paper representations were deeply embedded within leveraged financial structures. The result was a temporary collapse in prices that confused observers who focused solely on supply and demand, while missing the more important reality that the market's ability to function smoothly had been compromised. Authorities responded in those periods with measures designed to restore confidence, rather than resolve root causes, providing liquidity backstops, expanding balance sheets, and signaling support to stabilize markets. These actions succeeded in halting immediate cascades, but they also reinforced a system increasingly dependent on intervention, where participants came to expect that liquidity would be supplied whenever stress emerged. Over time, this expectation encouraged greater leverage and thinner margins of safety, reducing the system's tolerance for shocks. Each cycle of intervention shortened the distance between stability and instability, making future disruptions faster, sharper, and more difficult to contain. What appeared, in retrospect, as a series of isolated events was in fact a continuous process of fragility accumulation, masked by periods of calm and rising asset prices. The relevance of this history to the present moment lies in the unmistakable similarity of conditions now emerging. Once again, markets are exhibiting abrupt price adjustments driven less by valuation shifts than by the sudden need for cash. Once again, assets traditionally viewed as stores of value are being sold alongside riskier instruments, not because their role has changed, but because liquidity is being prioritized above all else. Once again, observers are tempted to dismiss the move as seasonal, technical, or transitory, overlooking the deeper signal that the system's capacity to absorb stress is diminishing. The silver market's sharp decline, occurring in tandem with broader liquidity tightening, fits precisely within this historical pattern, raising the possibility that what is unfolding is not an anomaly, but the early phase of a familiar sequence. When these episodes are examined collectively, a recurring pattern becomes evident. Systems that rely on confidence and leverage tend to function smoothly until a threshold is crossed, at which point small disturbances produce disproportionately large effects. Early warning signs often include widening spreads, declining depth, and price movements that appear disconnected from underlying fundamentals. These signals are frequently rationalized away, as participants assume that liquidity will return or that interventions will restore order. Yet history shows that once confidence in liquidity erodes, it does not recover instantly, and each attempt to stabilize the system becomes more reactive and less effective. This pattern is not driven by malice or conspiracy, but by structural incentives. Institutions optimize for returns during stable periods and for survival during stress. And when stress arrives, their collective actions reinforce rather than counteract market movements. Selling begets selling, not because participants share a narrative, but because they share constraints. Liquidity, once abundant, becomes scarce precisely when it is most needed, transforming markets into amplifiers of pressure rather than shock absorbers. The current plunge in silver, occurring amid broader signs of dollar scarcity and funding sensitivity, suggests that this amplification mechanism is once again asserting itself. The critical question, then, is not whether this pattern exists, but whether it can be interrupted before it fully unfolds. In previous cycles, intervention eventually arrived, but only after significant dislocation had already occurred. Prices overshot to the downside, confidence was shaken, and systemic vulnerabilities were exposed. The present situation raises the same uncomfortable issue: whether the signals now visible are being recognized for what they are, or whether they will once again be dismissed until the pressure becomes impossible to ignore. As liquidity continues to thin and volatility rises, the trajectory increasingly resembles earlier episodes that few anticipated, but many later claim to understand. What distinguishes the present moment from earlier liquidity disruptions is not merely the repetition of familiar stress patterns, but the narrowing of options available to contain them. In past cycles, markets entered periods of strain with deeper buffers, more flexible policy frameworks, and a greater willingness among institutions to expand balance sheets in pursuit of stability. Today, those buffers are thinner, both financially and politically. Banks operate under tighter capital and liquidity regulations that limit their ability to intermediate risk during stress, while central banks face constraints imposed by persistent inflation, elevated debt levels, and diminishing credibility. The tools that once provided rapid relief now carry higher costs and more uncertain outcomes, reducing the margin for error at precisely the moment it is most needed. Compounding this constraint is the structural depletion of real supply across critical commodities, including silver, driven by years of underinvestment, rising industrial demand, and geopolitical fragmentation. Unlike earlier periods, when financial dislocations occurred against a backdrop of relatively elastic supply, today's market must contend with physical limits that cannot be resolved through policy signaling alone. Industrial users depend on consistent access to silver for manufacturing processes that cannot be paused indefinitely, while inventories have steadily migrated from visible exchange warehouses into opaque, long-term holdings. This means that paper liquidity can vanish far more quickly than physical availability can respond, creating a growing disconnect between price signals and underlying scarcity. Geopolitical realities further complicate the landscape. Fragmentation of trade relationships, strategic stockpiling, and the weaponization of financial infrastructure have altered incentives in ways that reduce cooperation during periods of stress. Trust, once implicit among global counterparties, is now conditional and unevenly distributed. In such an environment, liquidity is hoarded rather than shared, and defensive behavior becomes rational even when it exacerbates systemic strain. These dynamics make the current episode fundamentally different from earlier ones, not because stress is unprecedented, but because the system's capacity to absorb and redistribute it has been materially weakened. The result is a market environment in which conventional stabilization mechanisms may no longer operate smoothly or predictably. Interventions, when they occur, are more likely to be reactive than preemptive, responding to visible distress rather than preventing it. This increases the probability of overshoot as prices adjust rapidly in search of liquidity before policy responses can take effect. The sharp decline in silver, accompanied by signs of stress across funding markets, suggests that this process is already underway, raising doubts about whether traditional reassurances will be sufficient to restore confidence. Looking ahead, the most acute pressure is likely to concentrate within a narrow window where multiple constraints converge. As liquidity thins further, market participants face competing imperatives, balancing regulatory compliance, risk management, and capital preservation. These pressures are intensified by calendar effects, reporting requirements, and funding rollovers that force decisions regardless of market conditions. In such periods, intent matters less than constraint, as actions are driven by necessity rather than strategy. Prices move not because participants wish them to, but because the system leaves them little alternative. Within this window, volatility becomes self-reinforcing. Each price decline tightens collateral requirements, triggers margin calls, and increases the demand for cash, which in turn fuels further selling. Attempts to stabilize conditions through selective intervention may alleviate symptoms temporarily, but they do little to address the underlying scarcity of liquidity. As stakeholders react to unfolding events, rather than shaping them, the range of possible outcomes narrows, and the risk of abrupt dislocation rises. The unresolved tension at the heart of the current situation lies in whether the system can navigate this convergence without a more pronounced breakdown, or whether the visible stress in silver is merely the first clear signal of broader instability yet to surface. As stress becomes more visible, the narratives offered to explain it tend to narrow rather than expand, focusing on surface-level factors that preserve the appearance of control while obscuring structural realities. Market participants are reassured that volatility is seasonal, that liquidity always returns, or that price moves reflect temporary positioning rather than deeper dysfunction. Officials point to isolated indicators of stability, emphasizing headline inflation prints, employment data, or nominal growth figures as evidence that the system remains resilient. These arguments are not entirely unfounded, but they are incomplete, because they rely on metrics that function best during periods of stability and become less informative precisely when conditions deteriorate. Narrative stability can coexist with structural fragility, and history shows that it often does so until the moment it no longer can. Another common misconception lies in the belief that price declines themselves are evidence of reduced importance or relevance. In the case of silver, falling prices are often interpreted as waning demand or technological substitution, ignoring the role of liquidity-driven selling and the distinction between paper markets and physical realities. This framing assumes that markets always reflect value accurately, even under stress, an assumption that fails when liquidity is scarce. Price, in such moments, becomes a signal of constraint rather than worth, revealing where pressure is greatest rather than where value is lowest. Treating these signals as definitive judgments rather than symptoms risks misreading the trajectory of the system. There is also a tendency to conflate policy capacity with policy intent, assuming that because authorities can act, they will act decisively and effectively. This overlooks the growing gap between what is theoretically possible and what is politically, economically, or institutionally viable. High debt burdens, inflation sensitivity, and geopolitical fragmentation all limit the scope of intervention, even as expectations of support remain high. The resulting mismatch between expectation and capacity introduces a subtle but dangerous instability, as confidence rests on assumptions that may no longer hold. When these assumptions are tested, the adjustment is rarely smooth. What the current episode ultimately reveals is not a failure of markets in isolation, but the ongoing evolution of a system increasingly constrained by its own design. Liquidity, once treated as an ever-present feature, is now conditional and episodic, and its absence exposes the underlying architecture of risk and dependence. The plunge in silver is not an endpoint, but a data point within a broader process that continues to unfold. It reflects a system recalibrating under pressure, shedding illusions of permanence, and confronting limits that were long deferred rather than resolved. As this analysis concludes, the central issue comes into focus with greater clarity. The question is no longer whether silver will recover a specific price level or whether volatility will subside in the near term, but whether the mechanisms that underpin market liquidity can continue to function as assumed in an environment defined by tighter constraints and rising uncertainty. Is the current stress a transient disturbance that will be absorbed quietly, or does it mark a transition toward a more brittle and reactive financial landscape? And if liquidity is indeed vanishing at critical moments, what does that imply for assets, institutions, and policies built on the promise of its availability? These are not questions that resolve in a single session or a single headline. They evolve over time, often becoming clearer only in retrospect. For those seeking to understand developments before they are widely acknowledged, continued attention to these dynamics is essential. If you want to stay informed as this situation develops and as structural pressures move from the margins to the center of the financial system, consider subscribing for ongoing analysis that focuses not on noise, but on the forces shaping what comes next.